Hello and welcome to Ticker Tapes. Today we're taking a look at the world of ETFs, specifically the SPY, the S&P Tracker, the ARK Innovation Fund, TLT, the United States Oil Fund, and XLV, the S&P Healthcare Fund. Now the start of 2022 has tested investors who are trying to decide what higher interest rates and reduced stimulus mean for returns. There's also the question of whether tighter monetary policy will be able to halt the rise and spread of inflation, which is currently running at 7%, which means it's far too high to ignore. Investors in SPY, the S&P 500 ETF, can take some comfort from the fact that the blue chip equity index's total return was 26.89% last year. Will it be able to achieve another year of inflation-busting gains? It might be too early to say. Money has been flowing into SPY with $6.80 billion injected into the fund during the first week of January, according to data from BNK Invest. There are some reasons to be optimistic about U.S. blue chip equities. After all, the Fed noted that the U.S. economy is expanding at its fastest pace in many years, and that the labor market is also very strong. These factors could be reflected in Q4 earnings season, which kicks off in earnest this week. The ARK Innovation ETF is down by 10.60% over the year to date and posted a new 52-week low of $80.10 as tech and growth stocks sold off last Monday but then bounced. Price action that created a pattern known as a hammer on the ETF's daily candlestick chart, the hammer formation, suggests that the price is beating out a bottom and that buyers have assumed control of the stock. The Financial Times noted this week that company insiders at firms in which ARK is invested had sold $13.50 billion worth of stock and purchased just $11 million over the 6 months to the end of December. Elon Musk's recent sales of Tesla account for $10.70 billion of that total, but even if we strip out that ratio of 254 to 1 in favor of insider sales is not a good look. TLT, the 20-year plus Treasury bond ETF, appears to have found support after a week of bloodletting, which saw the largest outflows from the fund since March 2020. Bond prices, of course, move inversely to interest rates, and with Goldman Sachs suggesting that the Fed may raise rates 4 times in 2022, some redemptions were inevitable. Oil prices rebounded last week, with WTI crude rallying by 6.15% to take 1-month gain in the U.S. energy benchmark to 15.30%. USO, the EFT that tracks crude oil prices, was a beneficiary of those gains and saw its share price jump by 6.28%, and the fund is now up by 8.37% over the year to date. The next move in oil prices is unclear, but there are some signs that demand could be building again. The strength of the U.S. economy meant that there was an unexpected drawdown on reserves held at Cushing, Oklahoma this week, with an additional 4.60 million barrels being consumed. The S&P 500 healthcare sector traded flat on the week and even managed to make gains during Monday's tech and growth meltdown, a testimony to the defensive nature of some of the bigger names in the sector. XLV, the healthcare sector ETF, mirrored those moves.